Hello, everybody, and thank you for joining us today. My name is Jeremy Capron. I'm the Director of Research here at ROBO Global. I'm talking to you from New York City, and I'm joined by my colleague Lisa Chai, who's our Senior Research Analyst. And today we're going to be talking about robotics, automation, AI, healthcare technologies with a focus on deal activity, which is significantly increased in the past year or so. So we'll be looking at the data on both the private side and venture capital, as well as what's happening on the public equity side. And we'll be discussing some of the key trends that we've seen. And we just published a new report on that topic that is called Follow the Money, and that you can find on our website at roboglobal.com in the research section. So we'll be making references to this report. Feel free to go and download it. Before we dive into it, let me start with a quick reminder of what we do at ROBO Global. We are a research and investment advisory company that's focused on robotics, AI, and healthcare technologies. And 7 years ago, we put together a team of investment professionals and industry experts with that goal of designing investment strategies around what we believe to be the next technological revolution. And we look at robotics and AI as a set of general purpose technologies that can be applied to every industry, every market. Very much like the internet revolution over the past 20 years. And we think this is offering tremendous investment opportunities. So today there's a little more than $4 billion US tracking our strategies, primarily in the form of ETFs. The most notable is probably the ROBO Index, ROBO, which was the first robotics and automation ETF launched around 7 years ago. And our research led us to realize that something important was happening in two adjacent areas that are the artificial intelligence and the healthcare technology. So we introduced two additional index portfolios. THNQ, that's THNQ, that's our artificial intelligence index, and also HTEC, which stands for healthcare technology and innovation. And that's another index portfolio that's been live in the market now for over a year. And these are not your traditional ETF indices. Our strategies are research-driven. We combine that research-driven approach with the benefits of index investing in the ETF wrapper. So the portfolios are selections of best-in-class companies from around the world. They're small, mid, large caps. They are more or less equal weighted. It's a modified equal weighting system that gives a strong representation to the smaller and mid-sized companies than traditional market cap weighted indices. And the portfolios are very diverse. They have a very high active share relative to traditional broad equity indices. You'll find the overlap with the S&P 500 or an all world equity index is very low. And on the next slide, you can see that those strategies have had a very satisfactory performance since launched. 2020 in particular was a very strong year with double digits returns across the board. Please refer to the fact sheets of our indices on the website if you want more details. So with that, I'm going to pass it on to my colleague Lisa to get started with a view on what's happening on the private side and venture capital.
Thanks, Jeremy. 2020 was a record year for acquisitions of venture-backed companies. More than 1,500 companies were acquired for more than $149 billion. Within artificial intelligence technologies, what we're seeing is that global market leaders continue to acquire AI talent or AI startups. The past year was obviously a massive year of funding for robotics, AI, healthcare, and anything cloud related, driven by the COVID-19 pandemic that was really accelerated by the digital transformation initiatives. Fueled by disruptive innovations in AI, autonomous systems, genomics, and enterprise cloud, we anticipate this momentum to continue in 2021. I'm going to share with you some of the notable findings from our M&A report that Jeremy indicated. The funding for early stage and late stage growth companies in the US continued its record climb with 130 billion, up 14% year over year. We discovered that the most active fundings were in three segments: self-driving cars, fintech, and digital health, ranking in record investments. According to CB Insights, over 40 early stage AI startups have raised a combined 5 billion in equity funding from investors. And also in 2020, there was also an acquisition spree of AI companies by Apple, Amazon, Cisco, and Microsoft since the pandemic started. Most notably, Apple has acquired more AI startups than any other company. We have seen these large tech companies be pre-active in M&A before the pandemic, but it seemed to have really accelerated after the pandemic as well. Companies like Apple basically doubled down in their investments during this time. Another notable aspect is that as consumers spend more time at home, the larger tech companies are not just in acquisition mode, but are also actively participating in venture investing through their corporate venture arms. Startups acquired or invested by many of these large companies spanned everything from e-commerce to autonomous systems to augmented reality to AI video games. And during the year, some of the big exits of AI companies included Amazon acquiring Zoox, autonomous system provider, for 1.2 billion. And there were several key IPOs during the year in AI, like Lemonade, a fintech provider, and C3 AI, enterprise AI company. And some of the other exciting funding news during the year was SpaceX raised 2.4 billion, bringing the total funds raised to 4.5 billion. UiPath, a robotic process automation provider, raised 1.2 billion. And autonomous ride-hailing provider Waymo One raised 2.2 billion. China was also very active during the year, where 3 of the top 5 mega raises were allocated to cloud-based technology companies in trucking, online learning, and online real estate. These 3 investments alone combined were over 6.5 billion in US dollars. China continues to be very acquisitive in bringing AI talent through acquisitions. In terms of European venture market, it declined slightly year over year. It really declined sharply when the pandemic started, but it bounced back nicely in the second half of last year. So it seems to be on that upward trajectory. In healthcare, global healthcare funding reached new highs in 2020 of 80.6 billion across 5,500 deals. This increase represents a 41% growth over the prior year. VC funding was also pretty global across regions, North America, Asia, and Europe, with the largest increase seen in Asia, which was up about 70% year over year. Digital health funding overall is really at all-time high at 27 billion. And we'll go a little bit more into digital health later on the presentation. I want to just touch on a couple of things regarding Think THNQ strategy. That is, as Jeremy indicated, it is our newest strategy to join ROBO Global with its focus on artificial intelligence. Our index companies are enablers and users of AI, and their aim is to go after massive revenue opportunities over the next decade as the spending in AI systems poised to accelerate. Some of the key themes to highlight from the M&A report for Think. Think Index members largely benefited from the COVID-19 pandemic. And they were looking to aggressively leverage their presence and build capabilities and features. So for the most part, companies small and large spent their cash being acquirers than being acquired. Many of our companies in the past year are saying that top priority for capital allocation is M&A or increase their R&D spending. And that is exactly what they did. As buyers have unprecedented levels of cash in this low interest rate environment, and with some of our index members using their stock as leverage to acquire AI talent, collectively, 55 of our 70 index members spent over $200 billion acquiring companies in the last 14 months. That translates to 230 M&A deals that were announced by our index members. During the year, just 3 of our index members have had offers to be taken out in the past year. So we're seeing very active environment for acquisitions of AI and data management capabilities by our index members. This is not at all surprising, as there has been this massive deployment of capital investments by enterprises around the world to take advantage of the cloud scalability and to build this modern IT architecture that you're hearing about. And you need that modern IT architecture to run the sophisticated AI systems. Our index members want to really take this opportunity to be a part of the big technology build out that's happening over the coming years. Meanwhile, after deceleration of semiconductor M&A in 2019 due to the US-China trade war, semi deals bounced back strongly in 2020. There were 4 mega deals in semis during the year, as the industry is consolidating once again and expanding into the future of high performance computing and AI. Software sector also continued its trend of mega deals in 2020 as a growing focus on adding software capabilities has only expanded. Many of these multi-billion-dollar cloud acquisitions are unsurprising, as businesses around the world are on a race to move their data to the cloud. So few of the deals on the M&A, Grubhub, Think Index members sold to Europe's food delivery company called Just Eat Takeaway for $7.3 billion. Salesforce announced their intent to acquire Slack for $28 billion, which was the largest deal in the company history. Twilio, a cloud communication software company, acquired Segment for $3.2 billion to expand its API world. And they're providing tools to support software developers and adding various AI capabilities. A quick look at the portfolio construction. All 11 subsectors delivered strong returns, driven by outstanding performance across the board, but particularly in e-commerce, cognitive computing, healthcare, and cloud providers in the last 12 months. I think it's important to note that Think has a very low overlap with the MSCI World Index, as well as S&P 500 Index and various other competing indices. Our top 10 holdings capture all of the companies that are enablers, developers, and users of AI, with high revenue and investment purity around AI capabilities. Those are some of the key factors that we look for in the member selection process for Think. And we think that makes us quite unique. In terms of market cap, Think Index members has a diversified exposure. Its median market cap is around 38 billion. So it does tilt to larger cap companies than the HTEC or ROBO strategies, because we believe that in order to build and develop AI capabilities, you need really strong financial resources and team of AI experts. However, we do have a good representation of the index members with lower market capitalization as well. For example, on the top 10 holding list, about 40% of the companies have a market cap between 3 and 12 billion. So it is a pretty good diversified group of companies. Now we're going to cover HTEC, HTEC, which is the Healthcare Technology and Innovation Index portfolio. Last few years have been a very strong year of M&A deals in healthcare. In 2020 alone, 5 of the 85 index members received takeover offers, bringing the total number of takeover attempts since the inception of the index in 2019 to 7. Meanwhile, M&A activity involving our index members as the acquirer have increased to 88 deals involving 52 index members and totaling over 67 billion. We believe that we will see continued M&A activity in various segments of our healthcare subsectors where we have exposure in. We believe that longer term, deal activity in the genomic space, especially in genomic diagnostics and gene therapy, will continue. We also expect to see many pharmas and large healthcare providers who will be adding AI capabilities through acquisitions or strategic partnerships. We believe strongly that these innovative healthcare companies in the HTEC index will continue to be sought out. M&A for non-traditional assets in healthcare, such as software or digital health, are rapidly accelerating as companies seek out new areas to secure growth. We also think medical instrument industry is quite attractive. It has good margins, stable business base, regulated environment, so higher barriers to entry. And there's a need for continued consolidation. Companies are constantly looking to augment their capabilities, especially in areas of new treatments or procedural solutions that integrate implants or other enabling technologies. As I mentioned that digital health is seeing strong deal activity, virtual care market is a $250 billion market alone. COVID-19 pandemic has placed a spotlight on the traditional care delivery markets. We are seeing healthcare industry embracing technology innovations through acquisitions as we enter this digital era that focuses on the patient's user experience. We think that diagnostic tools with machine vision, AI software, and other digital plays will take on a variety of forms and will continue to be an attractive asset. In terms of notable M&A highlights during the year, Teladoc's acquisition of Livongo for $18.5 billion marks the largest digital health transaction in history. This combination creates one of the largest telehealth companies with remote monitoring capabilities. Meanwhile, Philips announced its intention to acquire biotelemetry for $2.8 billion during the year. Biotelemetry currently monitors over 1 million cardiac patients remotely with its wearable heart monitors. So it would be a nice addition to Philips' digital health portfolio. In early cancer detection, we saw active M&A activity as well, with Illumina and Grail, Exact Science of Thrive for $2.5 billion, and Invitae's acquisition of ArcherDX for $1.4 billion. As cancer testing gets more sophisticated, it opens doors for precision medicine innovation so we can have personalized cancer therapies. In terms of the portfolio construction, I think what differentiates us from other healthcare strategies out there is that you can see from the sector weighting chart that we're very diversified with 9 subsectors that are shaping the future of healthcare. We have stronger exposure in digital health and life science tools because of our large emphasis on early detection and early prevention. And in the past 12 months or so, telehealth, data analytics, and genomic sectors were our top performing sectors. There has been tremendous value that is being created by these companies that are enabling virtual care visits, sequencing the genomes to diagnose drug therapies and viruses like COVID-19. And much like the ROBO and Think strategies, HTEC Index has a diversified exposure and has a lower overlap with the global indices as well as other healthcare related indices. And in terms of market cap, HTEC is truly diversified with large cap taking up just half of the portfolio. There are many underfollowed and small to mid cap companies represented in the HTEC strategy that we believe will be the winners of the next decade or so. Now I'm going to pass it back to Jeremy.
Okay, thanks very much, Lisa. So we've talked about what's happening on the AI side And on the healthcare technology side, I want to bring the conversation back to robotics and automation. And before I do that, I want to remind everyone, if you have any questions, feel free to use the Q&A box at the bottom of the screen. We'll be happy to take your questions in a few minutes. So, M&A has been a very strong tailwind to the Robo portfolio since we first designed it 7 years ago. In those 7 years, we've seen 23 takeover attempts on our portfolio companies. So think about that in the context of an index that has just over 80 members. So, that's an annual pace of about 3 takeouts per year on a portfolio of 80 plus companies. And typically the premiums that we've seen have been running in the 20 to 50% range. So that's a decent a boost to total returns over time. And in the past 12 months, we've seen a clear acceleration. We saw 7 deals in 2020. And there was one more that was announced just last month. So, the run rate's pretty high, and I think that's a reflection of what's happening in the tech marketplace as well. So it's basically, that growing appetite from larger, slower organizations that really realize or understand that they must have a presence in robotics automation. They must have capabilities because this is where the future is going. And many of those larger organizations have put that as a higher priority in terms of a strategic objective to play in those markets. But they also struggle to build them. So they decide to acquire it. And that's really what we've seen, last year. And I put up on the screen here, those 7 deals in 2020 to give you a sense of the diversity of them and how they basically touch almost every sector of every of the 11 sectors in our classification. So, those companies are ready to pay up. I mentioned the premiums typically between 20 and 50%. So let me go over a few of those deals. At the very top, you can see Isra Vision. That is a German computer vision company, relatively small, that accepted to sell to Atlas Copco, a much larger industrial group from Sweden. And that happened early in 2020. And next up, you can see QIAGEN, that's a specialist in automated molecular diagnostics that received a bid from Thermo Fisher. That didn't go through, but certainly helped boost the valuation of QIAGEN in the stock market. The next one here is Varian. That's been a very long-term holding in Robo. They're the leader in the automation of the radiation therapy for cancer treatment. Very large business that is going to Siemens Healthineers. That's the healthcare arm of the German group. And then next up, you can see Xilinx. That's in the process of going to AMD. So Xilinx is a semiconductor company that makes FPGAs. They are the leader in FPGAs, which are chips that are very good with AI applications. So that deal is still in the works. Holosys, that is a Chinese company that is one of the leaders in industrial automation in the Chinese market. Also a very long-term holding at Robo. It's received a takeout offer from a group led by the former CEO. And that stock we've seen trading on relatively low valuation for some time. And that's another signal that there are assets like Holosys out there that are trading below intrinsic value. And then you can see Omnicell. Omnicell, probably a lot of you haven't heard of this company. It's a California-based business that does pharmacy automation. So think about central pharmacies in hospitals. It's the automation of the medication process. Been a great business. And here again, the company received an offer. The board evaluated it and found, the offer was too low. So ultimately, it's been rejected. But you can see Omnicell stocks has been running since. And then finally, that's a deal that Lisa mentioned because it touches a company that's in both the Robo portfolio and the HTEC portfolio, and that is biotelemetry that does the remote monitoring of cardiac activity. So they do wearable devices that track your cardiac activity. So I think also, it's important to reiterate here that a lot of this activity is happening on with smaller companies, and that's why we think it's important if you run a robotics automation strategy to have that focus on smaller and mid-cap companies where a lot of the action is, the growth, the innovation, but also the M&A. So next, I want to touch a little bit on the Robo portfolio as it stands today. And this really shows diversification in terms of the vertical markets that are addressed by these companies. And you can see that this portfolio is not only about companies making robots and autonomous systems, but also the companies that make the technologies that enable that. So think about the sensing. I mentioned the computer vision company, ISRA. Think about the computing and the semiconductor level. Think about the actuation, which is how those systems interact with the physical world. And so you'll find here highly engineered components that go into robots or automated systems in factories and the likes. And those are the green segments on the left-hand side of the pie chart. And on the right-hand side, you can see the subsectors where we have companies that provide turnkey automation solutions for specific industries. So manufacturing, of course, and factory automation. And then you can see logistics and warehouse automation, which is about, a lot of that is about supporting the e-commerce boom. So you'll find companies that do mobile robots for warehouse automation, or the track and trace technology to track packages and parts in a supply chain. You'll find software companies, the software that automates the warehouse and things like that. And then healthcare, of course, that's around 10% of the portfolio. And on the right-hand side, you can see the performance for each of those subsectors for the past 12 months and in Q4. And you can see that really portfolio doesn't rely on a specific subsector to drive the performance. We've seen really, really good performance pretty much across the board. And on the next slide, I want to show some of the top holdings, but really, think about Robo not as a concentrated portfolio. You can see the top 10 holdings account for less than 20% of the index. And that's because we use that modified equal weighting as opposed to market cap weighting. So you'll find that the 80 plus holdings all have a weighting that varies, between 0.8% and sometimes up to 3%, but every quarter will be rebalancing and resetting those weights to maintain that diversification. And on the left-hand side, you can see what I call the high active share. That means most of these companies are not in traditional equity portfolios because they are not in the broad equity indices. You can see the overlap with the S&P 500 is very low, similar with the All World Equity Index. And you can also see here that the overlap with other robotics and automation indices in the market is very low. So one last word on the Robo Index. That's really, again, reiterating the fact that we have that tilt towards small and mid caps. So on the next slide here, you can see the breakdown between small, mid, and large caps, and that large caps are less than half of the portfolio. So I think we're going to leave it here for the prepared remarks. Would love to get your questions, and I'm going to look into the Q&A box here, and we get started. Let's start with the question around the valuations, and maybe Lisa, you could take that. Do you think that the portfolios have a high PE, and that may drop as the tech industry is getting crushed in the stock market right now?
Definitely the THNQ strategy is slightly different, that it does have that larger cap exposure, as well as larger technology exposure. So it does tend to have a higher PE multiples. Because many of these companies are in their growth mode, we found that PE was not really a good metric to use. We've been using enterprise value to sales as a appropriate multiple. But the EV sales actually also tend to be a little bit higher too versus the other strategies. We are seeing some correction happening. We think that much of the companies and the subsectors that we talked about, they benefited greatly from the COVID-19, benefit. So as many people relied on e-commerce and online video content and video streaming to kind of keep us entertained, many of these companies saw real big surge in growth, and you're seeing that fundamental kind of flowing through. And we do think that some of the investments that they're making will flow through stronger revenue growth over the coming years. But currently, of course, there's some mild correction happening. You'll see that less happening with the ROBO strategy or the HTEC. I think we get a lot of the questions as to what's so different about THNQ versus ROBO, and you'll see that it's a very different strategy, and THNQ has a larger technology exposure, but the fundamentals are really strong right now. And the companies realize that digital transformation has been accelerated by many, many years. So if you do believe that this modern IT architecture that's been built, and you're seeing massive deployment to the cloud, you're seeing the migration of the data going into cloud, and you need artificial intelligence to kind of capture all that and extract intelligent insights, you could see some of these companies kind of growing to those multiples.
And thanks, Lisa. I see we have quite a few questions around valuations, also in specific areas of the portfolio. So let me add a little bit to that. I think it's really important to understand that what we're trying to do with those portfolios is to mitigate that valuation risk by having a diversification. And so, and sometimes you're going to see specific areas of robotics AI, overheat. And so a good example of that would be, what happened with 3D printing stocks in 2013 and 14, when they went up, 10x. And then in the following 2 years, they collapsed by 80%. But 3D printing stocks in the ROBO Index, would be at most, total 5% of the portfolios. So you catch the valuation expansion on the way up, but because of that quarterly rebalancing, every quarter we're going to be going back to that equal weighting, and so we're going to be selling a lot of the stocks that have gone up perhaps too much, and that's a mechanism that's embedded in all of our 3 index portfolios. So we've seen that play out a few times in different areas, and I think that's where the benefit of diversification and frequent rebalancing come to the front. There's a question, Lisa, about the profitability of companies in those portfolios. Can you comment on that for Think and maybe for ROBO and HTEC separately?
I think the profitability, I think I indicated earlier that many of these companies chose to chase revenue growth given the massive opportunities right now. So you're going to see some of the companies with less profitability. However, when we dug deeper into the percentage of companies, we're looking at maybe over half the companies actually have very strong profit. You're also looking at about 65 to 70% companies actually have a very strong net cash positions. So they're positioned very strongly versus other companies out there in our competing indices. Versus the Robo and the HTEC, you're going to see greater profitability. The companies are a little bit more established in the Robo strategy versus a Think. And I think those are the biggest differences. So you should look at Think as companies that have that high pure revenue purity around AI. Many of these companies are building and developing AI systems, and the deployment and adoption around AI right now is still in its early inceptions. So because we're in that early stage of the cycle, you have to expect some of these companies to put some of their growth back into the company for future revenue growth.
Yes, and Lisa, I think it's really important to differentiate the Think portfolio from the Robo portfolio. When in Robo, the vast majority of companies are very profitable, and there's only a few exceptions in terms of companies that are earlier in their stages of development and not yet profitable. Those are a small minority. If you look at the Robo portfolio through the traditional investment factor lens, you'll find that it scores very high on quality because those companies are selected as technology and market leaders. Most of them are very established, proven business models, and they have fat margins and high return on capital. That's what you see for the Robo portfolio in aggregate. Whereas in Think, there's a lot more growth and a lot of companies that are really prioritizing their growth over turning a profits. So think about those portfolios, separately. I think they're very different beasts. There's a question around the geographic breakdown. What percentage of the portfolio is associated across Asia, Japan, US, and Europe? Maybe Lisa, you can start with Think, and I'll take it for Robo.
Okay, for Think, it does have a very US tilt. About 70, I believe about 78% of the companies are US based. So we do have many countries and other regions captured in the index, but you have to look at some of the background on some of the venture investing that happened around AI came from the Silicon Valley US companies. And then so many of the pure kind of revenue purity AI companies are developing AI systems and also leveraging AI. We have found them, most of the companies, to be in the US. So you're gonna have the outcome of our process was that it was a very heavily US tilt. However, we do have many countries captured in the index, I think about 15 countries. So about 22% are about 28% are international.
Thanks, Lisa. And when it comes to Robo, there's a lot of geographic diversification. You have around 45% of companies that are based in the US and 55% international. And in total, you have 12 different countries represented. And I'd say compared to a broad global equities index, you'll find that Robo is overweight Asia, where you find a lot of the robotics leaders are located, and also a lot of the growth in terms of demand for automation equipment and solutions. So you'll see that Japan, is a little over 20%, and then you'll find countries where you have that engineering expertise, places like Switzerland and Germany and Korea. And then there's a decent amount of exposure to China as well. Next, I want to take this question about the index construction process. I see there's questions around whether we can include late-stage private companies in the indices. I see a question around the process to select companies. Lisa, do you want to take the one around the private companies first?
Yeah. So with the all of our indices are publicly traded companies. We do look at a lot of the late stage private companies for research purposes, as well as possibly these companies are going to go public and maybe they would be eligible to be included in the index. So we keep a very close eye on the private markets, and that's why we're doing this call, because we have pretty much every day look through some of the private players, who are the players in the ecosystem that we look at. So it's very important to us to really closely track many of these companies. And when we do find a few that we would love to be included in the index, we do follow them through the IPO process. So, but currently there are no private companies included in any of the indices.
So I'm going to give a quick recap of our index construction process. I mentioned earlier it starts with research, and really that's the biggest factor in terms of how we select companies. How do we do that research? Well, we do traditional investment research. We meet with the senior leaders of the companies. We research their customers and their suppliers, and we look at the competitive landscape. We attend trade shows, investment conferences, and so on. But we also look at the technology. We do technology analysis because we basically take the long-term view in terms of what's going to drive eligibility for the portfolio. And we score every single company in our monitored universe on a number of metrics. The first one is really the revenue association with the themes that we look for. So you saw the various subsectors that compose every index. We measure the percentage of revenue from the company that are geared to those sectors, and we look for a very high percentage of revenue. So that's one part of the score. We also look at technology leadership and market leadership. Those are more qualitative metrics, but they're very important drivers of long-term value creation. And so technology leadership, that's essentially a track record of being on top of their market in terms of innovating, in terms of coming up with new products and services that the market demands. And the market leadership is really a measure of the market share. So we score companies on those metrics. We make sure that they don't fail our ESG policy. So we integrate ESG factors in our research. We basically kick out companies that fail our ESG policy. And so that gives you, a score, and the highest scoring companies are eligible for the portfolios. And then from then on, what we do is the more quantitative aspects of portfolio construction, which is that equal weighting and that quarterly rebalancing. So I hope that's clear. I see there's a question around the turnover rate for each fund. Lisa, do you want to start with Think?
I think the turnover rate for all three are obviously very different. I think every quarter when we rebalance, we have maybe one or two changes, right, Jeremy? But we look at all of the three strategies because of the research process that we undertake. We take a very long view in every one of our index members, and that's why we have those subsectors that we have already classified. So the turnover rate is pretty low, and you have to look at some of these strategies as a very long-term view of where the robotic revolution is happening, where the AI adoption, the AI transformation is happening, and also where healthcare is being disrupted by a lot of the technology that's enabling some of the innovations.
Yes, and I think measured on an annual basis for Robo, you're going to be at around 25% turnover. And that's really that quarterly rebalancing that drives it, more so than the inclusion or exclusion of stocks which really happened at the margin. As Lisa said, 1, 2 changes every quarter in terms of constituents, but really resetting the weights is what drives turnover of around 25% annual.
Yeah, and that's the same for the Think and HTEC as well.
Do we use technical analysis to buy and sell stocks? Lisa, you want to take that?
No. And I think that's, predominantly because of the research process that we do. We have a very a sort of a top-down view on our subsectors. We have already identified where we want to capture some of the exposure that we think are really cool and interesting and where it's going to grow. And then we identify companies within that subsector. So this tremendous research that goes into the research team and our strategic advisors collaborating. What are the companies that have these leadership? Who has a great technology? And how are they using that? And we follow through their earnings results. And all of that work, I think, would be kind of undermined by using technical analysis. So our strategy is very actively research driven. I think I think I take a look at it just out of curiosity to see where it goes, but it hasn't been a very strong factor. We have a scoring system that we have a very strong kind of discipline in our process where we have a scoring system for the leadership's technology investment for the Think strategy. Investment is a very important metric. Not so much in the other strategies, but we think that companies that are investing AI today will see, and that would be a strong indicator of future revenue growth. So investment is a pretty strong factor. So some of these scorings are real fundamentals drivers of the companies rather than technical.
Thank you, Lisa. Okay, I'm going to take this question around the year-to-date performance of Robo and how much of that is attributed to the cyclicality of the portfolio as the market sentiment has shifted in that direction. So that's a really good question. When we look at the performance of Robo over the past 5 years is returned just under 25% annual. But it hasn't been up every year. And in fact, there's a good portion of the Robo portfolio that is cyclical in nature, and that's primarily the companies that work with factory automation. And we think that's around 35 to 40% of the ROBO Index, where you have companies that play in those markets, and those markets are more cyclical. So, what's happened in recent months is that we've had a confirmation that we've entered a new upcycle in terms of factory automation. Of course, we had a big bust when the COVID hit in March, and we saw manufacturing indicators go to multi-decade lows. So manufacturing activity came down, and the companies in the automotive industry, electronic devices, and all sorts of other consumers of automation equipment really slammed on the brakes in terms of their capital investments. And I think it's important to understand that this happened, that shock happened after a very long down cycle. In 2018 and 19, manufacturing was already slowing because of the US-China trade war, among other reasons. And so we had that really, that shock coming into sort of culmination of a 2-year down cycle. And since then, things have been picking up, and really the equity market is starting to feel a lot more comfortable with cyclical sectors and cyclical stocks and value stocks. We've seen some of that rotation play out, and that has supported the Robo performance. In fact, since around November, so as much as the 2020 returns, Robo was up 45% in 2020. that was led by the digitization plays, the work from home enablers, the e-commerce enablers, um, and that drove the performance. But in the last 3 months, we've seen that other 35-40% of the portfolio start to come back. That gives us confidence in terms of what can happen in 2021, the type of returns we could expect. We maintain a positive view here. I think we have time to take a couple more questions, so feel free to send them in. Lisa, I'm going to direct this one to you around SPACs. There's a lot of interest in SPACs right now. How quickly are we able to consider adding recent SPAC combinations to the indices?
So yeah, we get that question a lot. I think the way we look at companies, as they go through the stages of late stage private into sort of the IPO stage, we look at the companies as kind of a standalone rather than saying, let's buy SPAC companies. So if we have a company that went through a SPAC, we'll take a look at it, but it really has to be around the time of the rebalance. So between the rebalance time, we don't just add some of these companies, whether they're SPAC or not. But I think that definitely the world has kind of evolved in the way we look at the SPACs in general, and you're seeing some higher quality companies coming out using SPAC as a one kind of a distribution method. So we're not against SPACs. We actually have one company we added in ROBO strategy recently that went through a SPAC combination. But we looked at the company as a standalone business as to see what type of growth opportunity can they monetize. And we went through sort of due diligence process that would be exactly the same as any other company that would be eligible for the index.
Thanks. And Lisa, I'm going to direct another two questions to you. First one, are you investing in companies using blockchain technologies? And do you ever buy a stock without any revenue, just a good idea and a good management team?
On the first question on blockchain technologies, we do have companies that have exposure, some revenue exposure to blockchain technologies. We currently do not have a blockchain subsector in the think, so it's not something that we're looking at closely. However, many of our semiconductor companies are providing processing chips for the mining equipment. We also have companies like Square that are investing in Bitcoin. So we do have the blockchain exposure indirectly, but it's not one of the kind of a key criteria for us. And the second question was around revenues. Because we look for companies with market leadership, we're looking at number one, number two market leader in their respective spaces. And because we go through this sort of the due diligence process, and I would say at Robo, what's unique about us is we do look for companies that are more established players. So all of our companies have some type of revenues. Some may have less revenue than others, but you definitely have to have that trajectory in revenue growth. So if you're investing your 20% of your sales in R&D, we need to see that translating into revenue. So that's very important to us. It's very, very rare to have a company with a declining revenue growth coming into our index.
Thanks, Lisa. I'm going to take that question about exposure to Japan in Robo. Many of the leaders in industrial robotics automation based out of Japan, such as Fanuc, Yaskawa. Can you comment on that exposure and its level in the index? Yes, this is a really good point. Japan was one of the first movers and dominant players in factory robotics, starting more than 20 years ago. And so today, you'll find that the dominant players in factory robots are still Japanese companies, and Fanuc and Yaskawa are good examples. They are included in in Robo, you'll find a lot more Japanese companies, including those that make some of the core components. So think about the reduction gears, the speed reducers for that rotational motion. Those are highly engineered pieces that come from two Japanese companies, Naptesco and Harmonic Drive, that basically control the global market for that. It's virtually a duopoly here. And then you'll find companies in industrial automation as well, companies like Omron and Keyence that make sensors. And Keyence has been a phenomenal business, phenomenal investment over the years, and they've grown into a very large cap today. So a lot of investors have never heard of Keyence, but Keyence is already in the top 3 in terms of market cap in the large indices in Japan. So in total, we have about 20% of the Robo portfolio in Japan, and we really don't find that kind of Japan exposure in our other index portfolios. I think in the interest of time, we're going to stop here. I see there's a few more questions we haven't answered live. We'll make sure to follow up with everyone offline. So I want to thank everyone for joining us today. We really appreciate your interest in Robo Global and our investment strategies. And we look forward to speaking again with you soon. Goodbye.
Thank you.